Every time the stock market crashes, trillions of dollars seem to disappear overnight. But here's the part nobody explains. That money doesn't simply vanish, so where does it actually go? And once you understand the answer, you'll never look at a market crash the same way again. I'm Gavin, and today we're going to follow your money through a market crash, from your 401k to your savings, your home, and even the cash sitting in your bank account. By the end of this video, you'll know exactly what happens to every dollar you own during a market crash, and why understanding it could save you from making the same costly mistake millions of investors make every single time. So let's start where every market crash begins. The first domino. Contrary to what most people believe, a market crash doesn't begin when the stock market opens. It doesn't begin when investors panic. And it doesn't begin when billions of dollars are wiped off the market. It begins much earlier. The moment people stop believing tomorrow will be better than today. Maybe inflation comes in much higher than economists expected. A major bank suddenly reports massive losses. A company misses earnings by a wide margin. A war breaks out, or a global event sends shockwaves through the economy. Whatever the trigger, investors everywhere begin asking the same question. What if things get worse? That single question spreads through Wall Street faster than almost anything else. Large investment firms begin reducing risk. Hedge funds start selling. Institutional investors rebalance their portfolios. And then, something happens that most people never see. Within milliseconds, trading algorithms detect the selling pressure and automatically place even more sell orders. Suddenly, millions of shares flood the market, and that's when prices begin to fall. Not because every company suddenly became worthless overnight, but because there are now far more people trying to sell than there are people willing to buy. Think of it like selling your house. Yesterday, 10 buyers wanted it. Today, only 2 show up. If you still want to sell, you have one choice. Lower the price. If nobody buys, you lower it again. And again. The stock market works the same way. Prices don't fall because money disappears. They fall because confidence disappears. And once confidence starts falling, fear spreads even faster. Within minutes, every financial news network is flashing bright red. Markets in free fall. Worst day since. Investors panic. Your phone won't stop buzzing. Breaking news alerts. Text messages from friends, co-workers asking, "Have you seen the market?" Then you do what millions of Americans do during every market crash. You open your retirement account. Yesterday, it showed $180,000. Today, it says $145,000. Just like that, it feels like you've lost $35,000. Your heart starts racing. Your mind immediately begins asking questions. Should I sell? What if it keeps falling? What if I lose everything? And this is the exact moment where most people make a critical mistake. Not because they don't understand investing, but because they're human. Behavioral economists call this loss aversion, simply put. The pain of losing money feels much stronger than the joy of making the same amount. That's why market crashes don't just affect portfolios, they affect decisions. History has shown that millions of ordinary investors sell during moments like this, not because they've carefully analyzed the situation, but because fear convinces them that getting out now is the safest option. Ironically, the most experienced investors often react very differently. Not because they can predict the future, and not because they know exactly when the market will recover, but because they understand something most people don't. And that's exactly what we're about to uncover. Because while everyone is focused on falling stock prices, your money isn't sitting in just one place. Some of it is invested in stocks. Some is inside your 401k. Some is sitting safely in your bank account. Some is tied to your home. Some may even be in bonds, gold, or cash. And here's what surprises most people. A market crash doesn't affect all of those dollars in the same way. Some lose value almost immediately, some barely move at all, and a few may even become more valuable. So let's follow your money, $1 at a time, and see what actually happens the moment the market begins to fall. What actually happens to your money? So, the market is crashing. News headlines are everywhere. Your retirement account is falling, fear is spreading, and now comes the question every investor eventually asks, what actually happens to my money? To answer that, let's follow the money of an average American. Let's call him Michael. Like millions of Americans, Michael doesn't keep all his money in one place. Some of it is invested. Some of it is saved. Some of it is tied to his home. And some of it is simply sitting in a bank account. During a market crash, every one of those dollars behaves differently. Your investments get hit. First, the very first place. Michael notices the damage is his retirement account, his 401k, his Roth IRA, his mutual funds, his ETFs. Almost all of them are invested in the stock market, so when stock prices fall, the value of those accounts falls too. That's why millions of Americans open their retirement accounts during a crash and suddenly see balances that are 20%, 30%, or even 50% lower than they were just months earlier. But here's where most people get confused. That money hasn't actually disappeared. Not yet. What changed was the market value of those investments. Think of it this way. Imagine your house is worth $500,000 today. Tomorrow, buyers are only willing to pay $420,000. Did your house physically lose $80,000 overnight? No, the market simply values it differently. Stocks work the same way. Until you decide to sell, that loss is mostly on paper, and history has shown that markets have recovered from every major crash, from the Great Depression to the financial crisis to COVID, even though some recoveries took much longer than others. But what about your bank account? Michael's next thought is probably the same one millions of Americans have. If the market is crashing, is my money in the bank safe? For most people, the answer is yes. The money sitting in your checking or savings account doesn't rise and fall with the stock market. If you had $10,000 in your bank yesterday, you'll still have $10,000 tomorrow. In the United States, bank deposits are also protected by FDIC insurance, up to the legal coverage limits. So, while investors watch stock prices plunge, their cash in the bank usually stays exactly where it is. Your emergency fund has a different job. This is exactly why financial experts recommend keeping an emergency fund. Not because it's going to make you wealthy. It won't. Its job isn't growth. Its job is stability. If Michael suddenly loses his job, or an unexpected expense shows up, that emergency fund becomes his financial safety net. But even cash has an enemy, inflation. If prices keep rising, the money sitting safely in your bank slowly loses purchasing power. In other words, cash protects you from market volatility. But it doesn't always protect you from inflation. Then Michael starts looking at his home. Next, Michael starts thinking about something much bigger, his house. If the stock market is falling, will home prices crash too? The answer: sometimes. During the 2008 financial crisis, average U.S. home prices fell by more than 20%. Millions of homeowners suddenly found themselves living in houses worth far less than they had paid. Foreclosures surged. Construction slowed. Banks became much more cautious about lending. But that's not what happened during every market crash. During the COVID crash, aggressive interest rate cuts and massive government stimulus helped fuel one of the strongest housing markets in decades after the initial shock. And that's an important lesson. Not every market crash affects every asset the same way. The cause of the crash often determines which assets suffer the most: safe haven or just different risk. As fear spreads, investors begin looking for safety. Some buy U.S. Treasury bonds, others buy gold, some simply move into cash. These are often called safe haven assets because investors expect them to hold up better during periods of uncertainty. Meanwhile, riskier investments usually experience the biggest declines. And this is where one of the biggest misconceptions begins. People say, all that money disappeared. But that's not what's really happening. Money isn't disappearing. It's moving away from assets people suddenly fear, toward assets they trust more. And that brings us back to the question we asked at the very beginning. If millions of people are selling, who's buying? Because someone has to be on the other side of every trade, and once you understand who those buyers are, you'll finally understand where the money actually goes. Where does the money actually go? So, if trillions of dollars don't simply disappear, where do they actually go? The answer is surprisingly simple. Most of the time, they don't actually go anywhere. Let me show you why. Imagine you own one share of a company. Yesterday, someone was willing to pay $100 for it. Today, because investors are afraid, the highest offer is only $70. So what happened? Did someone steal your $30? Did it vanish into thin air? No. The market simply changed its opinion about what your share is worth. That's why you'll often hear headlines saying billions or even trillions of dollars were wiped out. But in reality, what disappeared wasn't money. It was market value. And there's an important difference. Think of it like a famous painting. Today, collectors are willing to pay $10 million for it. A year later, the highest offer is only $7 million. Did someone lose $3 million in cash? No. The market simply decided the painting wasn't worth as much anymore. Stocks work exactly the same way. Their prices rise and fall based on what buyers are willing to pay at any given moment. But someone is buying. Now here's the question almost nobody asks. If millions of people are selling, who's buying? Because every single share that's sold has to be purchased by someone else. Every single time. And the answer usually isn't ordinary investors. It's pension funds, mutual funds, insurance companies, market makers, institutional investors, and sometimes the very billionaires everyone assumes are panicking. Why? Because they understand something fear makes everyone else forget. A lower stock price doesn't automatically mean a worse business. Sometimes it's the exact same company, making the exact same products, serving the exact same customers. Only now, its stock is trading at a much lower price. That's why legendary investors like Warren Buffett often remind people to be fearful when others are greedy, and greedy when others are fearful. Not because crashes are enjoyable, but because panic sometimes creates opportunities that simply don't exist when everyone is optimistic. The domino effect. Unfortunately, a market crash rarely stays inside the stock market. It begins spreading through the rest of the economy. As stock prices continue falling, companies become more cautious. Expansion plans are delayed, hiring slows. Some businesses freeze recruitment. Others begin laying off employees. Consumers notice the uncertainty. People spend less. Restaurants become quieter. Vacation plans get canceled. Large purchases get postponed. As consumer spending falls, business profits begin falling too. And lower profits give investors yet another reason to sell. It's a cycle. Falling confidence pushes prices lower. Lower prices reduce spending. Lower spending hurts businesses. And weaker businesses create even more fear. That's why market crashes don't just affect Wall Street. Eventually, they reach Main Street when banks get nervous. But the ripple effects don't stop there. Now imagine you're running a bank. Yesterday, the economy looked healthy. Today, markets are crashing, businesses are struggling, people may start losing their jobs. Would you become more willing to lend money or more cautious? Most banks choose caution. Loan approvals become harder. Credit standards tighten. Businesses find it more difficult to borrow. Families have a harder time getting mortgages and personal loans. Economists call this a credit crunch. And when borrowing slows, economic growth usually slows with it. That's another reason a market crash can spread far beyond the stock market itself. Then, the Federal Reserve steps in. And this is usually when another major player enters the story. The Federal Reserve. When financial markets become unstable, the Fed's goal isn't to stop stock prices from falling. Its goal is much bigger. To keep the financial system functioning. It can lower interest rates, provide emergency liquidity to banks, or purchase government bonds and mortgage-backed securities to keep credit flowing through the economy. In other words, the Federal Reserve isn't trying to save the stock market. It's trying to prevent panic from turning into a full-scale financial crisis. We've seen this happen repeatedly, from the financial crisis in 2008 to the COVID crash in 2020, when aggressive action helped stabilize markets and restore confidence. But history keeps teaching the same lesson. Every market crash feels different. When you're living through it, it always feels like this time is different. This time the market won't recover. This time the economy won't recover. This time everything has changed forever. People believed it in 1929. They believed it in 1987. They believed it during the dot-com crash. They believed it in 2008. And they believed it again during COVID. Yet history keeps telling a different story. Markets have survived wars, recessions, financial crises, pandemics, political uncertainty, and countless moments when investors believed the system was broken. Yet over time, markets have repeatedly recovered, sometimes quickly, sometimes painfully slowly, but they recovered. So, if history keeps repeating itself, why do millions of investors continue making the same mistake during every crash? The answer has very little to do with money, and almost everything to do with human psychology. Why millions of investors make the same mistake. If history has shown that markets eventually recover, why do millions of people still panic during every crash? Because market crashes don't just test your portfolio, they test your emotions. And that's where most people lose. Your brain wasn't built for investing. Imagine spending 20 years building your retirement savings. Month after month, year after year. You watch your balance slowly grow. Then, in just a few weeks, 30% disappears. Even if nothing has changed about the companies you own, your brain doesn't care. It sees danger. Thousands of years ago, fear kept humans alive. If our ancestors heard something moving in the bushes, the safest decision wasn't to investigate. It was to run. That survival instinct is still with us today. The only difference is, the danger isn't hiding in the bushes anymore. It's a screen filled with red numbers. Behavioral economists call this loss aversion. Simply put, losing money hurts far more than making the same amount feels good. That's why market crashes feel so overwhelming. You're not just watching numbers fall. Your brain believes you're losing something you already own. Then, everyone starts copying everyone else. But fear doesn't stay with one person. It spreads. The more people panic, the more convincing that panic becomes. Friends start selling. Co-workers start selling. Financial news talks about panic. Social media predicts another Great Depression. And suddenly, selling feels like the only logical decision. This is known as herd mentality. People naturally assume that if everyone else is doing something, it must be the right thing to do. But history has repeatedly shown the opposite. By the time most investors finally decide to sell, much of the damage has often already been done. And that's one reason emotional decisions can become so expensive. History keeps repeating the same pattern. We've seen this story before. In 1929, panic selling helped turn a market crash into the worst economic downturn in modern history. In 1987, the stock market lost more than 20% in a single day, yet the broader economy avoided another Great Depression. During the dot-com crash, investors chased technology stocks to unsustainable prices before reality caught up. In 2008, the collapse of the housing market triggered a global financial crisis that wiped out trillions in household wealth. In 2020, markets fell at record speed as the world shut down because of COVID-19. And in 2022, rising inflation and aggressive interest rate hikes pushed markets into another bear market. Different causes, different decades, the same emotions, fear, panic, uncertainty, and every single time, millions of people convinced themselves, this time is different. Yet every one of those crashes eventually became another chapter in financial history. The biggest myths about market crashes. Before we finish, let's clear up a few of the biggest misconceptions. Myth number 1, I lost all my money. Not necessarily. If you haven't sold your investments, you've experienced a decline in market value. Not necessarily a permanent loss. Myth number 2, my bank account will disappear next. For most Americans, insured bank deposits aren't directly affected by stock market declines. A market crash and a banking crisis are not the same thing. Myth number 3. Cash is always the safest place. Cash protects you from market volatility. But over time, inflation quietly reduces what that cash can actually buy. Sometimes today's safest feeling creates tomorrow's biggest risk. Myth number 4. The stock market is just gambling. Speculation can absolutely be gambling. Long-term investing is something very different. When you invest in a diversified portfolio, you're buying ownership in real businesses that create real products, employ real people, and generate real profits. So, what actually happens to your money? Let's go back to the question we asked at the very beginning. When markets crash, where does the money actually go? Now you know the answer. Most of it doesn't disappear. Market prices change. Some investors sell, others buy. Money moves away from assets people suddenly fear, toward assets they trust more. Confidence falls, prices follow, and eventually, confidence returns. That's the cycle we've seen repeat throughout modern financial history. Final thoughts. The next time you hear someone say, "The market just wiped out trillions of dollars," remember what you've learned today. Money doesn't simply disappear. Market values change, confidence changes, fear changes, and eventually, markets change too. Because every major market crash in history has felt like the end while people were living through it. But history tells a different story. Markets recover, businesses adapt, confidence returns, and the investors who understand that cycle are often the ones who make the calmest decisions when everyone else is panicking. That's why understanding what really happens to your money during a market crash isn't just interesting. It may be one of the most valuable financial lessons you'll ever learn. If you enjoyed this deep dive and want to better understand how money, markets, and the financial system really work, consider subscribing. Thanks for watching, and I'll see you in the next one.